Hello, chart watchers, and welcome to this Friday, November 2nd, Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, market's a little skittish today. We got the Dow Jones Industrial Average currently down 85 points. The S&P 500 down about 16. The NASDAQ down 65. The Russell 2000 fractionally higher, up just under 1 point today. 10-year Treasury yield hopping higher, up about 6 basis points. We're going to talk about non-farm payrolls in a bit, but those numbers came in hotter than expected. Volatility index, which had gone down to about 18 earlier today, is now back up over 20. It is up more than 5%. Leading to the upside, industrials having a pretty nice day, continuing its recent move to the upside. Discretionary stocks, same thing. These two groups leading to the downside. Technology, it is down almost 2% today. A couple of industry groups that I thought might bear some recognition here today, or at least give you some idea of what's going on. Home construction stocks, for the first time in a while, starting to show some strength yesterday. Did manage to close above the 20-day, but today, putting in a reversing candle here, it looks to me like home construction might be topping in the short term. We want to keep an eye on that. Pharma's also coming up, challenging a downtrend line. Got right near some key moving averages, also putting in a reversing candle. And then finally, computer hardware struggling today. Of course, Apple reported after the bell last night. We'll take a look at that earnings report in a bit and Apple's chart. But computer hardware down, you can see 172 points to 2803. So a pretty big drop in that space. All right, Erin, it is Friday, November 2nd. Wow. Again, can't believe how fast. Yeah. You got any big plans?
Oh, you always ask me that. I always feel so lame when I don't have any.
I'll just keep asking until you have some.
Yes. Actually, yeah, we do have a Ducks game. We have a Ducks game on Sunday, but we're not actually going because we're going to a wine dinner. One of our favorite things to do. So I guess that is some plans.
Yeah, wine dinner. That's big plans.
Time to explore the market a little more, too, over the weekend, figure out what's going on.
Yeah, well, good luck there. But we do have Mary Ellen McGonagle back with us today for What's Hot, What's Not later in the show. You got any hot plans this weekend, Mary Ellen?
I am in the Big Apple, New York City, and my daughter's here. We're going to go out and explore this wonderful town and see what trouble we can avoid.
All right, so we got Apple in the news for a couple of different reasons today.
There you go.
There you go.
Yeah, we're going to come back, and I know that there's a lot, at least this week, we have a lot of what's hot instead of what's not. So we got a bunch of that we'll go over in a little bit, so stick around if you can.
Sure.
All right, Erin, what do we got today?
You bet.
All right. Well, let's see what's coming up next week. I will be doing a workshop on Tuesday, probably about trend and condition. We'll see. Brian Livingston will be with us on Wednesday. The muscular portfolio is what he'll be talking about. Grayson Rose will join us on Thursday, and then I don't think it's on the schedule, but Mary Ellen will be back on Friday of next week. All right, but today we do have, after technical news and headlines, Mary Ellen's going to get started on that what's hot, what's not. 10 and 10, our first symbol is going to be Pitney Bowes, PBI, if you want to go look at that chart and see what you think before Tom tells you what he thinks. And then I'll finish off the program today with the sentiment update to let you know what's going on out there. Everybody's saying they're feeling one way, but is the money going that way? I'll be telling you at the end of the show. All right, Tom, technical news and headlines. I know, like you hinted at some interesting economic reports.
Yeah, the biggie. I think it's the stock market's earnings report, kind of. Non-farm payrolls. We get it out the first Friday of each month. And so we got October non-farm payrolls out this morning. 250,000 came in much better than expected, way above expectation. You can see also private payrolls beat by a wide margin. Unemployment rate did match expectations at 3.7%. Average hourly earnings rose 0.2% as expected. And then at 10 a.m., we had September factory orders came in, and they were a little hotter than expected, 0.7% versus 0.4%. And all of that, when you bundle it together, means there's a lot of selling going on in treasuries, and the yield is moving higher. Let's just make sure we have this updated because it has been moving this morning. Yeah, still trending higher. We are above 3.20%. And off of this uptrend, this is now beginning to look to me like a potential inverse head and shoulder, a bullish continuation pattern off of the high we saw in early October. The pullback could be left shoulder, neckline back up above 320. A lower low puts in the head, inverse head. And now we've gone back through that 20-day moving average and testing just above that 320 area. This could be a neckline. Of course, we would need a little bit of a pullback to establish a right shoulder and then be watching for a breakout. But the pattern, I think still, whether it's inverse head and shoulder, whether it's, you were looking at this, maybe it's just an ABC correction. Well, however you look at it, I think it still looks pretty bullish. I think the long-term chart on the 10-year Treasury yield breaking out above that 3.11% was pretty big deal. And I think eventually, maybe sooner rather than later, I expect we're going to take out that 3.25% area. Okay, let's take a look at some charts because we got a lot of earnings news really still coming out. That's going to continue through next week for sure. But first, let's take a look at some of the earnings reports here summarized for you. We've got Apple, 291 versus 279. Starbucks, 62 versus 59. And I know, Erin, we had a poll out not that long ago asking, which stocks we thought might get the biggest bang after their earnings reports came out.
Right.
Starbucks, I didn't look at the others. I know Apple and Starbucks were like 1 and 2 in our poll. Yes. And of course, Apple went down, and Starbucks is the one getting a really nice reaction to its earnings.
Mm-hmm.
So anyway, but we have some other big earnings on the screen there for you as well. Alibaba, ExxonMobil, Chevron, all came in better than expected, and ABBV beat expectations as well. So some pretty good news overall in terms of earnings, but the market looks ahead, and that's where I think traders are having problems with Apple today. So let's go back and take a look at their chart here. You can see the gap down. The stock now is down more than 6%, almost 7% today, and it is close to the low that was established back on Monday. So Apple getting to a key area. I think if it drops much below 205, it's probably heading back into this gap support zone. Apple beat on the top line, beat on the bottom line. The problem was they guided their Q1 revenue midpoint and their gross margins below estimates. Now, I kind of like the fact that they come out and at least tell you ahead of time what's going on, and the stock was downtrending heading into their earnings. So maybe some of this was shared with the investment community at some point recently, unlike Facebook, which we've talked about plenty. But back in July when they reported, of course, they just came out and said, we're lowering our operating margins, but the stock was trading at an all-time high heading into that report. So I kind of like the fact that Apple beats on the top line, beats on the bottom line, and then issues the warning after the stock has already been down some. I think it's probably going to catch some support down in this gap support zone if it doesn't hold on around 205. That's something to watch for perhaps later today. Let's take a look at Starbucks. Starbucks, this is really big for a number of reasons. Clearly, you can see the gap up. This is a 1-year chart, so it's at a 52-week high. That's nice. But when we take a look at a longer-term chart, I'm going to pull up the monthly chart and go back 15 years. Look at the sideways consolidation on Starbucks for the last few years. This action today is a breakout to all-time highs on Starbucks, clearing sideways consolidation. This is a bullish pattern, continuation pattern, and this breakout, I think, adds to it. So this is potentially a really big day for Starbucks unless we see a reversal. They beat on the top line just barely, $6.3 billion versus $6.28 billion. Beat on the bottom line, 62 cents versus 59 cents. And you can see that market reaction. I always like to get that market reaction. Let's take a look at a few others that we mentioned just a couple minutes ago. Alibaba missed on the top line. So they did beat on the bottom line, as I showed, but the revenues came up short, and they guided next year's revenues lower. Stock continued its oversold bounce, but you got to wonder now, it's up against this resistance area just below 155. It's getting close to that 50-day moving average, which you can see over the last 3 or 4 months has been really difficult to get through. I don't know. We'll have to wait and see if Alibaba can make the breakout above that 50-day. I doubt it's going to happen, at least not in the near term. ExxonMobil, they beat on the top line by a pretty wide margin, beat on the bottom line by a pretty wide margin, gapped up. Things look good, except check out the overhead resistance. The last reaction high was up between 82, 82 and a half. Today's high, 82.45 with a reversal. I think a close back up above that 50-day would be great for ExxonMobil. Short of that, I'd be a little careful. CVX in the same space. Chevron, of course, missed on their top line by about over $3 billion, $43.99 billion versus $47.17 billion. So a pretty big miss on their revenues. Beat on the bottom line, though, 211 versus 206. You can see false breakout filling this gap, now trading back down near the low of the day and back below that 20-day moving average. Don't like the way CVX looks at this point. ABBV, a nice reaction at the open, but again, you can see reversal. Stock beat top line, beat bottom line, guided their fiscal year 18 EPS higher, increased their dividend, and for all of that, the stock's down 0.3%, down almost 0.6%. Not a good reaction, and that's what I pay most attention to is the reaction, not so much what they report. ACIA, just a couple other reports I thought looked interesting. Acacia Communications, look at the breakout here. Nice move, great volume, beat top line, beat bottom line. Bottom line, 42 cents versus 17 cents. Pretty significant beat there. They guided in line going forward, but this is a stock, when you look back, had really taken it on the chin after the huge move up in 2016, all the way back down. It now seems to be gathering itself for the potential maybe of another uptrend, and that breakout here looks pretty good, especially if we hold it into the close. Did want to mention FTNT, Fortinet. This is one of the highest scooters among software stocks. They came out, they beat top line, they beat bottom line, they guided in line, and the stock is breaking down. And as we take a look at the software group, this was a leader. Notice today, 2 of the last 3 days, we've had intraday moves through the 20-day, failure to hold it. And unfortunately, that's what I'm seeing in the market. The S&P 500, talked about this all week in my blog, 2720 to 2760 short-term resistance. You can see the 2760 coming in at gap resistance. Also, the declining 20-day moving average right now is 2749. We got up above it intraday, but have reversed. And at this point, that is reversing candle. And keep an eye on the volatility index, the VIX. Big reversal here on the VIX, heading back up. So I'm not saying we're going back down for an extended period, but this is an area where I would be very careful because it's an area where I would have expected perhaps a reversal and a move back to the downside. All right, Erin, lots of upgrades, downgrades. What you got today?
All right, there are a lot, that is for sure. I noticed we even have those extras when I give you those other big name upgrades, quite a few out there. So let's take a peek here. I'm going to start with the upgrades. We're going to look at Fluidigm, FLDM. Piper Jaffray upgraded it from a neutral to an overweight. Investors are very happy about that. There are a couple of things I wanted to point out on the chart. First of all, of course, obviously, we have a breakout from that declining trend. However, notice we are currently trading well below that intraday high that we had, but we've got a PMO buy signal turning up just as it's gone below the zero line. Scooter's still pretty healthy, and notice right here in the thumbnail that 20-day EMA managed to tip just above the 50-day EMA, to stick above that. If we had gotten that negative crossover, of course, that would have been a decision point neutral signal. So we're seeing a lot of volume coming in so far on this rally. We'll have to see where it finishes off the day, but I think it's got a really good chance now, just because it's hit that intraday high, of eventually getting up there if we do end up closing a bit lower. Next, Michael Kors. Piper Jaffray and UBS both upgraded Michael Kors from neutral to buy. A few things to keep in mind when I look at this chart for this chart. Number one, I didn't write in that support resistance, but we're now right above that. It was short-term resistance earlier. If you look in the thumbnail, I mean really short-term, a couple days. But we got that breakout. Intraday, we've managed to get above that 20-day EMA. But this is a big problem. We've got the 50-day EMA getting ready to cross below that 200-day EMA. And that's going to put Kors in Michael Kors into a bear market configuration. So just something to consider, because when you go into that configuration, you should start expecting your bullish outcomes not to happen as often as they may usually do when you see the 50-day EMA above the 200. But it's making a nice move. It's broken, like I said, above the 20-day EMA intraday, and the PMO looks pretty healthy here. Notice also OBV, we're starting to see a move out of that declining trend, which I think is also positive. Small increase in the scooter. So I think this one's going to climb higher. But I'd just be a little bit cautious there because of that bear market configuration on tap. All right, Parker Hannifin also upgraded today. Wells Fargo from market perform to outperform. I just wanted to point out on this chart that nice breakout that actually happened yesterday. However, we closed below that area, which you can see was the gap. We had that gap resistance. It also lined up here with the lowest close we saw back here in June and May. We managed to close the gap yesterday, but like I said, close below. Today, however, we've broken above that 20-day EMA and are trading above it. Notice the OBV is out of its declining trend at this point. And yeah, like I said, the PMO is headed for a buy signal. So I think PH looks a little bit less concerning than some of the others here. All right, Wells Fargo also upgraded Citigroup from a neutral to a buy, and I've got short-term resistance here noted. I was thinking about this as maybe a double bottom, but it's kind of messy. So I opted not to go with that. But I do see that a PMO buy signal. I do see an improvement now on the OBV. And, you know, it looks like we might be headed to break out above that short-term overhead resistance. The only issue I have is after that, we then have some very strong resistance that is lining up with those tops from May and June, a low back here in March. So that is going to be the proving point for Wells Fargo if we're going to get back above that. I'm a little bit cautious still about the financial sector, so I don't know that I'd be jumping in here. A couple of other big name upgrades before I talk about Gardner here. Bluebird was upgraded, BLUE. Apache was upgraded, APA. CF Industries was upgraded. VeriSign was upgraded, VRSN. And Comerica, CMA, all were upgraded today. All right, downgrades. Gartner Group IT was downgraded today by Piper Jaffray from a neutral to an underweight. I think this one has some potential if we can get the momentum to really shift. I mean, we managed to stay above some support. I noted back here from this top in June and these lows back here in that consolidation zone in August, and it held. Of course, that lines up too with the 200-day EMA, and that held. I'd like to see a close above that 142, 140. 250 area. I'd like to see a close above that and some trading above that before I would want to come in on this one. It is downgraded, so beware. There is the PMO still in decline. Next one, MDRX, all scripts, was downgraded today by Cantor Fitz and JPM and SunTrust. So 3 agencies all downgraded MDRX from overweight to neutral and from buy to hold. So basically they're moving from, the positive buy outlook to just hold it. Of course, I'd have been pretty upset if I were still holding it as of today. We do have a 50-200-day EMA negative crossover on tap. Of course, we have the giant gap down, a move of almost 17% to the downside right now. Of course, PMO pointed nearly vertical, and it looks like it's going to hit some lows we have not seen all year long. So something not the best looking chart, and I would go here to the weekly chart to see if we can find any support. And really, when you go back, it's the $9.850 range from back in 2012 where I would look for some support. Now, if we can hold this low from 2016, which we're trying to do right now, that could be an area of a move back up. But darn it, this weekly chart, ugly PMO, everything looks pretty ugly here. So I wouldn't be holding this, like they said. I'd be a little upset if I were holding it. Terex Corp was downgraded by Vertical Research from a buy to a hold. Not really much to talk about here. We have a PMO turning down below its signal line. You have to go to the weekly chart to go and find support at this point, and there are plenty of areas. I would look at that $25 range, and based on the PMOs, I would be looking for that to go, even though we have a 2.5% up move so far this week. And that's all I had. A couple of other big name downgrades. Apple was downgraded by B of A to a neutral. Kraft Heinz was downgraded. US Bank Corp, USB, was downgraded. Universal Display, OLED, was downgraded, as was UPS. And that truly is the end of the upgrades and downgrades. All right, Mary Ellen, time to come back onto the show here. And let's know what is hot. What is hot?
You bet.
Yeah, we're going to start off. I tell you what, this is going to be really exciting because the last couple of weeks, the market's been going down. I just wanted to highlight before you get going, I know you're going to start with some small cap stocks, Mary Ellen. For the first time in really the last 3 or 4 months, you can see that the Russell 2000 beginning to outperform the S&P 500. So I know you like some small cap names there. What do you have in terms of small caps?
Yeah, actually, there are a number of names, and I'll tell you this week, a lot of the bigger action, the bigger swings are definitely earnings driven. I'm going to go ahead and take you on a tour here of some of the stocks that really have been bouncing on both sides, up or down. But your biggest winners this week are those that are really super oversold, and the companies came in with earnings that were ahead of estimates, and also revenues were up. So what we're looking at here is another view. Tom was showing you the Russell versus the S&P. This is the Russell 2000 index small cap. And the reason I'm pointing this out, this index is up over 4% for the week. So it's certainly outperforming on a relative basis. And a lot of the broader markets, when you look at this deterioration, it actually started well before the S&P and the NASDAQ. The Russell started to show signs of deterioration and cracking here in the beginning of December. And for those of you that have been following us each week, we talk about how small caps will lead the markets to the downside. And that did in fact come to bear. But let's take a look at where we are more recently, and it's really quite encouraging, this rally this week. And what I wanted to point out to you here is the small caps also tend to lead us out of difficult periods. So I'm taking you back to this really tough period, January, February. We had that horrible correction, but it was small caps that first started showing signs of life. So you will want to take a look. I have the stochastics down here on the bottom, and you want to look for this upward, exactly what we're seeing here above this net neutral. RSI is poised to turn positive. So a continuation of strength in small caps would be quite constructive. And let's go ahead and drill down. We'll take a look at some of the names that have been most highly impacted. And you'll take I'm sure you'll be able to see quite quickly just how oversold some of these stocks are. This is Lending Tree, TREE. We're looking at a daily price chart. There's two things I want to point out to you. One is this gap up that occurred on their positive earnings report last week. If you can note, take a look at that huge volume, highly constructive. And even more importantly is today's continued advance. We're up almost 5%. This huge gap up yesterday, well over 20%. We're seeing even more upward momentum. And you will see this in a number of stocks we're going to be reviewing, primarily because of this very deeply oversold position. And so a lot of this could have been short selling, short covering, but then more in the way of the management guiding higher going forward. So we can see, I would argue at this 200-day simple moving average, this blue line, you very well may get resistance. And I can show you one other stock here, LWS is another one, came in, earnings were flat, but management guided higher going forward. And this huge gap up, almost unreal looking. But again, coming out of a deeply oversold position, that's what you're going to see here. FIT is Fitbit. And this is another company. They did come out with better than expected earnings because of price increases. They increased their price, deeply oversold. This is what you're going to see with these earnings reports that are positive and these huge gaps up. Another stock that is up 3.5% beyond yesterday's gap up on earnings. This is a more constructive stock. It's broken up above those simple moving averages, so it allows it more room to move higher. So again, these undervalued stocks, they're coming in above earnings or sales, and the market's like that. So we can go ahead and move on. The next area that I wanted to point out to you within the broader markets that are really having a superior week are biotech stocks. So they're up over 8% on the week. I think you'll see a theme here in the sense that they really got beaten down. So the stocks that we're going to be looking at, well, actually, I'm going to be focusing more on those stocks that are constructive, not those deeply oversold bounces. They are a bit harder to play in the biotech space simply because you don't have the earnings, you don't have real drivers that could potentially propel it higher. So I will be focusing on stocks that, in fact, do have fundamentals that could potentially push them higher. So let's take a look at some of these biotech stocks. The first one is Amgen, of course, a bellwether, well-known stock within the industry. Amgen did come in with good numbers, but we can see that the advance that took place earlier this week is being given back. The stock's down 2%. So you'll see this with a lot of stocks in the current market environment where they are attempting to reverse their recent downtrends. But when they get beaten down, there oftentimes is quite a bit in the way of work. So we're not out of the woods by any means here with an Amgen. RSI tried to turn positive, is turning back. You're down below, we have the momentum MACD, nowhere near in positive territory, but I did want to point that out because earlier going into today, it had a nice bounce. Another biotech stock that we can look at is Vertex, VRTX is the ticker symbol. This is another one that sold off with the broader markets. It's attempting to reverse that downtrend. Again, we are not there yet. Take a look at the MACD. This is true of a lot of stocks. It's going to take work before they become viable. And for this one, you will want to see a break back above this red 50-day simple moving average before it becomes interesting. But here's a stock that's due up for earnings next week, NBIX, and it was a big winner going into this current correction in the markets. It's further advanced as far as that MACD, the RSI turning positive. Your MACD had a positive crossover. Ideally, we want it above this net neutral with a break above that 50, and this stock should be good to go. One last one is EXAS, and this is a company that came in with earnings that were about 13% ahead of estimates. And again, this is more constructive. Your RSI is positive. Your MACD had the crossover, poised to turn positive, and the stock price broke above that 50-day upward trending 50-day simple moving average, which is hard to find in this broader market.
Yeah,
so,
Mary, yeah, I was just going to say that the biotechs, they had dropped almost 400 points. The Dow Jones U.S. Biotech Index had fallen almost 400 points during the month of October, which is pretty unheard of. I mean, it was about a 17 or 18% drop in the overall group. So it's nice to see some of these stocks getting a bounce for sure.
You bet.
The financials, the XLF is one of the lowest scooters among all the sectors, and that group's been bouncing. I know banks have been lifting that group. Any particular bank stocks that you like there?
Yeah, that's a great observation because the financials are an area that just could not, just dead in the water, could not rally. And a lot of the financials, particularly banking and insurance stocks, they're driven higher by a higher interest rate environment, both for different reasons. And we did see the 10-year Treasury get up above 3%, but these financials just could not get out of their own way. But this week, we're seeing a nice rally in some of these stocks. And again, it is going to be earnings driven. But what I will point you toward right now are some of the bigger winners. And again, I think you will see a theme here. These are smaller regional banks. BANC is Bank of California. And what I wanted to point out to you here is just really how deeply oversold. This is what you're going to see in the broader markets, those stocks that are oversold the most. And you can tell they're oversold because within this RSI, if it gets below that 30, that's indicating oversold. Your MACD got below this net zero. So it is potentially turning out of it. This is earnings driven. So you do have an actual reason for this pickup this week. It's up over 8%, but we are still very far from being out of the woods. But just a pointing out to you, if you're looking for plays within earnings, take a look at some of those oversold, deeply oversold stocks that are coming in with earnings that are ahead of estimates. And then one other small one that we can look at here is GWB. These are both certainly California stocks. And take a look again at how really just deeply oversold. Investors just threw this stock away, but it is having a significant rally this week. Not a stock I would buy given these downward trending longer term moving averages, but just giving you a feel for your larger bounces are going to be in those oversold stocks. We can take a look at some of the bigger money center banks. This is Goldman Sachs, and this is another one that really got sold off quite a bit. It is attempting to bounce. It's up quite a bit for the week, but we have a lot of downward trending simple moving averages that are going to make any progress beyond 238. If it's able to break back above that on any kind of volume, then we're in better standing. We can take a look at JP Morgan, another large, well-known financial stock. Again, potential resistance right here at that 200-day. You can see that the RSI almost turned positive, not quite. So while these bank stocks are finally coming to life, they do still have more work in the way of turning what we would call positive as far as making them buy candidates. Take a look at this 50, 10-day, these shorter term simple moving averages very clearly. This is very heavy. It creates a pattern that's going to take work. It's going to take more back and fill before we can get excited about these. But certainly it is good to know that they are finally coming back to life here.
Okay, now the last couple of weeks when you were on the show, last few weeks, you've talked a lot about the retail stocks and some of the consumer cyclicals and how, for a while they were definitely leading the market, and we're starting to see them begin to lead again. Do you have some names for everybody for this week?
Yeah. Tom, that's absolutely right. So let's take a look at XLY before we get started, because as you may recall, last week I was a little excited that we were seeing pockets of strength within consumer discretionary stocks. And here's the reason. This is a daily price chart. And what I wanted to take you back to again is this correction that we experienced here in the beginning of this year. And I will tell you, the discretionary stocks were one of, software was the other, of the first groups to emerge out of this correction. So we had a lot of damage, a lot of downside going on around it, but these discretionary stocks did come to life. So the fact that discretionaries are rallying in here, I like to see that. There are, again, similar to that last period when they came back, there are pockets of strength. So let's go ahead and take a look at some of those areas. I will tell you that they are discount retailers is one area, FIVE. These are companies that are expanding. For instance, this is Five Below. This is a daily price chart. I really like this chart. It's up 9% for the week. And the reason that I do like this is that it has pulled back in what I like to call a very orderly fashion, not those big heavy breaks on volume that you're seeing in a number of stocks around it. The stock has now broken up above this 50-day simple moving average. RSI is turning positive, and your stochastics, this is your net neutral dash line. Also, this stochastics can be really quite helpful for identifying downtrend reversals, and we definitely appear to be on the way with FIVE. We can also take a look. These are stocks, before we move on, take a look at the significant strength that it showed relative to the broader markets. Again, a lot of it during that corrective phase. Ollie is another one. OLLI is the ticker symbol. It's Ollie's Bargain Outlet. And take a look. It really, you wouldn't know that the broader markets have had any difficulty during the month of October. Nice orderly pullback to an upward trending 50-day simple moving average. This stock also looks quite constructive. And one other name that we can take a look at here is Dollar General. And then we'll take a look at one last name that I've been pointing out over the last few weeks. Another discounter, again, no observance of what's going on in the broader markets, able to buck that downtrend. That's really significant. You want to key in on these kinds of stocks because when the broader market pressures really lift, these are going to be your better performers. So Dollar General finding support at an upward trending 10-day simple moving average. One last one, FOSL, and this is a stock that we've been pointing out over the last couple of weeks, actually because of its relative outperformance. Again, another really quite beautiful pullback to an upward trending 200-day simple moving average. RSI is turning positive, as is stochastic. So these stocks are going to get more and more interesting to these institutional investors as we get into the holiday season, and all eyes are going to be in looking at some of the same store sales numbers that these guys report.
Great charts there. I got another one for you in the consumer discretionary space. And this is an area of the market that prior to this week was the worst industry group over the last 6 months. It had been down close to 40%, and it's up 8% this past week. The gambling stocks. What do you like there?
Oh, yeah, you're right. And these gambling stocks have really suffered. And this is a deterioration that occurred well before the broader markets came into trouble. This is taking you back to, in fact, May. We could go back to February when these stocks peaked. Deeply, deeply oversold, many attempts to rally, but no real traction. So this week they are coming to life, and a lot of it, there's a very sound reason for that. The Macau stocks, the bigger name gambling casinos that have a presence over in Macau are rallying. Let's take a look at WYN. N is an example, viable or out of the woods, but they are coming out of deeply oversold positions. Macau is just reported their strongest numbers as far as casino action since 2014. So we can see this really deeply oversold bounce. Now, I would say you could very well rally up to this 124 level, but beyond that, this is a very heavy stock. But also, there's a Hong Kong to Macau bridge opened last week. It's the largest overseas bridge, and that's really has analysts excited as far as anticipation of continued casino revenue increases. This is MGM. This is one that I would say is a little further along in its upward potential advance. Again, you're going to want to watch how it behaves at that 31 level. But for a shorter term bounce, the RSI is positive, and your MACD has had that positive crossover. And
hey, I've got a question for you, and I don't know how much you follow the patterns, but I thought maybe you could. I'm looking at MGM, for instance, and the high that we're seeing right now. If you go back to the middle part of October, there was a similar high, and prior to that, could be like a reverse left shoulder. I was just wondering, do you look at when stocks are in downtrends like this, do you look for patterns to kind of confirm that a bottom has taken place, or do you just strictly look at price versus moving averages and that sort of thing?
Well, when we're down like this and you have these downward trending simple moving averages, this green line is your 10-day, this red is your 50-day simple moving average. That creates a very, very, very heavy pattern. What's going to happen is you're going to have these reversal attempts, and more often than not, they will be met with resistance. We had a very brief period where they were able to come up above, but by and large, you're going to find resistance. As these 50-day continues to decline, you're going to see these bounces, and they're going to get lower and lower. So what we need is a very, very sound break above this 50. You're going to want to see it occur on volume, because ideally at some point in time, you want this 10-day simple moving average to trend upward and break above the 50, all with an eye toward uplifting. So this would be a shorter term play for those of you, but not anything robust and longer term, because now you're in a phase where you could see trade up to potentially this 31 if the interest in these McCall stocks is sustained.
Yeah, I think that point you made too, Mary Ellen, was a very good one about volume, because if you go back and you look at the second half of July, when you did go above your 50-day moving average, that volume there was just not enough volume, I think, to take those stocks, or to take this stock higher. And then, of course, we had that next low come in right at the beginning of August. So volume, I agree with you. I think volume is pretty important to see that confirmation. All right. Well, that was a ton of what's hot. And fortunately, this week we haven't had a whole lot of what's not. But, I'm watching energy, and crude oil prices are down, I don't know, $63 a barrel, or they were earlier this morning, from about $75, $76 a barrel not that long ago. And with everything in the market bouncing, energy seems to be pretty weak as far as its bounce. What do you think about energy?
Yeah, so we can take a look. This is USO is the ticker symbol. It's the U.S. oil fund, and it's a really quick way to get a glimpse at oil prices, because there's both there's Brent and crude. There's two different oil pricings, but this really kind of marries them. So USO, we can see oil prices peaked and back here in October, and we've seen nothing but deterioration since then, and a lot of it geopolitical, OPEC related. But regardless of the reasoning, it has had a really severe impact, of course, on energy stocks. This is something we've been covering over the last couple of weeks, because your E&P, or exploration and production stocks, are going to be heavily most impacted by lower oil prices. It's going to reduce their profit margins. We're looking here at the energy sector, XLE, and you can see the damage has been really quite severe. So, of course, that is translating into energy stocks. Let's take a look at a company that actually came in ahead of estimates this week, and you can see that the overarching oil pricing, it could potentially keep this stock depressed. This is Exxon. They came in with great numbers. They beat, but we can see the stock is trying to rally, and we are here at this 50-day simple moving average. So it'll be interesting to see if these stocks that are coming in with these superior earnings are going to be able to override the really heavy impact that lower oil prices has. This is Chevron. These guys also came in with great numbers, and you can see the markets they're liking it, but not so much, because it was up quite a bit more, traded up to 117, and sellers are coming in. So that's not really constructive.
All right, got another area for you. I'd like for you to take a look at and give me your thoughts. Utilities. Now, of course, we've been seeing the 10-year Treasury yield rising again, and that makes those utility companies, their dividend yields not as attractive when the 10 years moving up. And of course, as the 10 years been moving up, the yield, we've seen the XLU moving down. What do you think about utilities here?
Yeah, and absolutely, Tom, you're making a great point, because the move into utilities that we saw, we're looking at a daily chart here. So this is taking into account October. This was all about a flight to yield, because when the stock markets were in, and still are in a deteriorating phase, we haven't gotten quite out of the woods yet, but when the markets really broke down, there was a flight to quality. A lot of money was driven into bonds, which in turn drove the yields down. So that sparked interest in the utilities. And since then, since we are seeing certainly this week a nice bounce, a nice possible recovery in the markets, the interest in utilities has dissipated. So you can see it's broken down below this 50-day simple moving average. Let's take a look at a stock within the utilities that these guys actually came in with really good earnings, and they came in ahead of estimates, but they were 45% ahead of estimates. But as you can see, the market really doesn't care. They're looking the other way. The stock did get hit. It's down another 2% today. So just a real stamp of disapproval now currently as it relates to these utility stocks.
Awesome. Well, how about aerospace? I mean, we've gotten a bounce there, but I know some of them have been struggling with some earnings. What about the aerospace group?
Yes. Okay. Yeah, we can take a look. So we talked about the moves this week being very driven by earnings, and this area is not an example. I'll tell you, after running lots of screens, it wasn't really easy to come up with areas that were not doing well. But there were some spaces, again, all very earnings related. This is an aerospace defense related stock, FLIE. And the company, they came in they came in with earnings that were fine, but they missed on revenues, and that really just disappointed the markets. So we can take a look at this gap down. This occurred on Tuesday. Take a look. It's hard to see behind there, but huge volume. This is telling you institutions that may have stuck through this downtrending period with the broader markets, they want it out. And we can see the stock's trying to wedge. It's trying to gain traction, but for all intents and purposes, FLIR is out of the game. We can take a look at another one. This is another stock that is earnings related, but also a lot of times you'll see when a company, FLIR was widely followed, and you will see a broadening out of other names within a given group also suffer. This certainly was not a pretty chart prior to the deterioration that we've seen this week. But just to point out, if you see some of these stocks that come in either above or below estimates, oftentimes there'll be a spreading out among other stocks within that group where analysts say, well, wait, if they came in below, let's look at the reasoning, and it could well affect the whole entire broader markets.
Yeah, I noticed too, in addition to aerospace, some of the defense names really have struggled as well. They've had a little bit of a bounce, but relative to their losses, I mean, I'm just thinking about companies like Lockheed Martin and some others that just haven't done very well. But let's keep moving because we got a couple more areas to cover. But medical companies, I remember last week you were on here and you were talking about ALGN and the fact that it dropped an earnings bomb on the medical community or medical company community area. Do you have some others like that this week? Oh, I think we may have lost Mary Ellen. Okay. Well, I know that there were a couple of companies, and I know this because she told me that there were a couple. So I think what I'm going to go ahead and do is go ahead and pull these stocks up that I know Mary Ellen wanted to talk about, and I can show you the charts. So let me first go into IART. This is Integra Life Sciences Holdings. This is a company that came out, disappointed the market with its earnings, gapped much lower. You can see clearing the prior support levels from back over the last 6 months or so. Definitely, with today's action moving lower, seems like we're probably going to go back.
Oh, hi, I'm back. Sorry about that. We just had a little momentary glitch in the internet connection. So if it's okay,
Yeah, go ahead and take it back. I didn't know if you were going to go back or not, but I was just starting in. I know that I was saying that last week we had talked about, well, you had talked about ALGN, Align Technology, dropping an earnings bomb on that medical company's area of the market. And you had a few others this week, I think, that you wanted to talk about. So.
Oh, absolutely. Yes. Good call, though, because that's really, Tom, worth pointing out. When you see these gaps down like this on huge volume, again, volume is going to tell you a lot. It's institutions that want out. This was a big winner, actually multi-year winner. ALGN could do no wrong. And
I'm sorry to interrupt you. I just want to make sure you don't have the screen right now. So I wanted to make sure you grabbed that.
Oh, thank you. Okay. Well, we'll go ahead and grab that back. And what we can see once I go ahead and show that screen to you is how it gapped down on really super big volume. And this is ALGN on a daily. Take a look if you can on that volume, huge. This is telling you that, again, this was a big winner, widely institutionally owned. They want out. So it's going to really take an awful lot to get this stock back in the game. IART was another really well-loved stock. Certainly going into the summer months, you can see this big run up here, but the stock has also got hit here with earnings. It was down 11% based on the company. They met their earnings, but they missed on revenues, and investors are just not having any patience for stocks that are companies that cannot come through on both sides of the equation. Here's another example, CSII, cardiovascular. This is another one where the earnings were flat and they missed on revenues. So take a look at this gap gap down. We can see this big volume here as people exited the stock. Once you break that 200-day, that's your blue line, simple moving average, you're going to have a really tough go trying to recover. So one other example here is Baxter BAX within the medical product space, another miss on earnings, gap down, huge volume. So I think you can see a theme, but I don't want to steer you away from the group. There are bright spots in medical products, and I don't know if we do have time, but there are cannabis related stocks that are down for the week, but are really closing the week in somewhat bullish fashion. Tom, do we have a second to?
Sure, yeah. Go ahead and pull them up. That's fine.
You bet. Okay, so here's TLRY. These are stocks that we've talked about in the past. And actually, let's see if we can get a more vibrant example here. CGC is another one of these stocks where we can see that we're looking at a daily, and you can see that earlier in the week they have gapped down. They are trying to rally subsequent to that. We're still going to have work to do. The RSI is still negative. You want that breakup positively. MACD not quite there yet. But for those of you that are interested and keeping an eye out on these stocks, I will tell you they broke down earlier, certainly Monday and Tuesday, and a number of them are trying to rally and come back. They are finding buyers here. From my work, a little too early, not anything I would touch quite at this point, but certainly worth noting as we go forward.
Awesome. Well, I tell you what, it's not easy to get through as much as you just went through in 30 minutes, trying to summarize everything that happened this week. But at least the news was mostly positive. We did have a good week, which is a good thing, right?
You bet. No doubt. It's certainly encouraging.
Yeah. Now, I'm going to put you on the spot. Do you think we keep going higher, or do you think we need a pullback after the strength we've seen this week?
I think we do still need a little bit more in the way of work. I'm going to really keep a close eye on how we close the market today. So a lot of my work has to do with, but I'm really, really encouraged, particularly with the action in the small caps. We're starting to see potential downtrend reversals. So I'm encouraged, but we do still have work to do.
No doubt about it. Well, I have to thank you. I know you're in the Big Apple
yes.
Week, and you were kind enough to take 30 minutes out of your schedule and join us. I really just want to thank you for stopping by.
Oh, you bet. Have a great weekend.
Yeah, look forward to next week. Thank you, and you too.
Great.
Okay, Erin, 10 in 10. What do you got?
Let's get started. Okay, I actually do have the RRG ready, so let's go ahead and take a quick look at it. PTI, certainly an outlier, and EXTR outliers. So we may go ahead and look at those, but I'm not going to make promises yet. All right, we had one comm services. Discretionary and technology are back on the interest level as far as viewers and what they'd like to see you annotate. So healthcare also a big one today. So let's go ahead and get started with Pitney Bowes.
All right. Pitney Bowes, first of all, I like what's going on here with this stock. We were in a downtrend for a while. I try not to call bottoms. I know when you wait for a change in character on a chart, that means you're not going to get it at the absolute bottom. But how many times along here might you have thought that, okay, this is a bottom, and yet the stock just kept going down? I wait, and let the stock get a little healthier. I think that happened. You can see this blue arrow right here pointing to the much heavier volume that came in yesterday. I didn't see the earnings report, but I'm guessing that was probably an earnings report on Pitney Bowes yesterday, or maybe after the bell on Wednesday. But great volume, breaking the downtrend. I don't like to chase, so this is one that would certainly be on my list, my watch list. A pullback, though, to test a rising 20-day at some point down the road, I think could be a great entry into PBI. I like it.
All right. And the most popular in the chat room is NVIDIA. So we get to look at that one today.
All right, NVIDIA. NVIDIA is doing kind of what I expected much of the market to do. I mean, we got up with that VIX in 30 range, 25, 30. We had the VXN, which is the NASDAQ's volatility gauge, got up into the mid to upper 30s. Well, I think maybe mid 30s. And if you look back at history, that tends to mark bottoms, key bottoms in the market. So I've been expecting the bounce, but there are key areas that you have to be looking for to see whether or not we can get through those. And when I look at NVIDIA, I think you've got a key gap area. We gapped down. You can see the volume picked up as we gapped lower. This move back up so far has failed at about the bottom of gap resistance. You've got the 20-day moving average in there. The PPO is extremely weak, telling us that selling momentum is accelerating to the downside. So when you do get an oversold bounce like this, I expect that it's going to fail in the near term as it approaches that 20-day moving average. And that seems to be what's happening right now with NVIDIA. It's come off the bottom quite a bit of late. I think the market has a chance here to roll back over. I don't know if we go back down to those lows that we had recently, but I wouldn't be surprised to see a little weakness in the near term. So I would pass on NVIDIA. I want to see some of these stocks get back up above some key moving averages like that 20-day, get through gap resistance, maybe through downtrends like we just saw in PBI. Those are the types of things that I'd be looking for that would suggest that the market overall is getting healthier.
All right. Number 3, let's look at an ETF, robotics ETF, BOTZ, bots.
Yeah, I like that ticker symbol, bots.
Right, I like it too.
Yeah, we made a move up above the 20, but so far we are reversing on that move and trading at the low of the day. I mean, there are a couple of good things here on the chart. First of all, we have been trading lower for quite some time. We bounced from about the $20 area, got up to 21 and change, and then went through 20. So on the way back up, you expect that 20 area to be resistance. You expect the declining 20-day to be resistance, and we gapped up above both of those today. So in the short term, I think that's a good thing. One big problem, no volume coming in, and I'm not a huge volume fan with ETFs, but it does at least show you whether or not there's interest in those particular stocks and in that area. So I'd like to see a little bit more volume coming in. And what I don't want to see here, if I'm in this, is a move back down below 20. So I'd watch for that level.
Okay. Next one I have for you is EXTR. And this one was one of those outliers.
Yeah, Extreme Networks reported earnings. I didn't see the numbers. I think they beat, and based on the reaction today, I'm going to say they most likely did beat on the bottom line. I'm not sure about the top line. There's the key area right there, and you can see intraday we went above that level, and now we've come back down. So for now, I would say we're still in this trading range between about 6 3/4 to the upside, maybe about 4 3/4 downside. I'd watch this area. But if we go back up and take out that high from earlier today, I think we have a really good shot to go back and hit this prior support level, which is now resistance up around 7 3/4. So I think EXTR is trying to put a bottom in here. But after moving up for 4 days and just now hitting resistance and temporarily failing, I think I'd put it on a watch list and just be watching it right now.
All right. Next one is an industrial, Ameresco, AMRC.
All right, AMRC. Well, nice breakout. Volume can be a little thin sometimes. This is the 100,000 level, and you can see many days we're well below that level. So it's a kind of stock that I probably wouldn't trade because I do think that there's usually stocks that are thinly traded. They're not profitable for most market makers. So you have fewer market makers that actually make a market in those stocks. And when you have fewer market makers, you're subject to a lot more manipulation potentially, because one market maker or a couple market makers see most of the flow, and they're the ones that are, trading those stocks. So I do think that that creates a little bit of additional risk, and you just have to be aware of that. Having said all that, we got a beautiful breakout, nice volume to confirm it. On a pullback, I would be looking for gap support between $14.50 and $14.50 and $15, and that also was the prior high back in mid-August, right about that $15 level. So if we get a pullback another 4 or 5% into this zone, that's where I would be most interested on the long side.
Okay, and let's see, for our Canadian friends, CJ.TO, Cardinal Energy, an oil and gas producer.
Yeah, it's doing about what energy and crude oil has been doing. I mean, it's just, this space has just been horrible throughout October. If there's one thing that's positive, the last major low that we set back in February, which is right at the 370 area. We went just below that earlier this week. We're back down testing it again. you could certainly trade it on the long side and just have a tight stop. We are oversold and we're hitting a major support level. I would expect at least a little bounce, maybe 20, 30 cents, get back up 410, maybe test that 20-day moving average, which is declining rapidly. But this isn't my style. I don't like getting in stocks that are trading down like this and hitting a year-long support. I like stocks that are outperforming on a relative basis and not, in this ski slope type of formation, unfortunately, that many of these energy stocks have been in. So you're at support. That's the good news. Bad news is obviously this has been a major underperformer, relative underperformer. And I would be careful if it loses that support from back in February.
All right. How about Hilton Worldwide, HLT?
All right, HLT. Yeah, I think I saw earlier that the hotels were doing pretty well, especially over the last week or two. And you can see that on the chart here with Hilton. We did break down, I think if you look at a couple of key lows on the chart and we draw our support resistance lines there, I think the April low was pretty significant. And we had gone down 2 or 3 months, established that as a low. You can see we went down and tested it in August. And then after that, we went back down and went to 72, bounced back to 75-ish or just below, and couldn't get through and went back down again. We're up into this zone now. Good news is we're back above the 20-day. The bad news is this is an area where we have struggled, and look at the volume declining as we make the move to the upside. I don't know. To me, it just looks a little suspicious here. I wouldn't be interested in this one until I could see a definitive move back above the 50-day moving average with some volume coming in.
Okay. Let's see. Kraft Heinz, KHC from Consumer Staples, of course.
All right, KHC, they did report earnings last night. They beat on the top line. They missed on the bottom line. I didn't see any guidance for them, but obviously the market just not liking what's going on here. So KHC to me looks like a breakdown on very heavy volume. I just can't see anything here that I like. Big volume, losing key support, downtrend followed by what looks to be like a bear flag, maybe even a little bit of a descending triangle, and the breakdown on heavy volumes confirmation. I think this one's starting another leg lower. I'd avoid it.
Okay. Let's see. 2 more to go. Let's look at GS, Goldman Sachs.
All right, Goldman Sachs. Well, I mean, the last couple of moves to the upside have failed in October, right near this 230 level. And we got up earlier today, 231. Now we're back to 226. And we're just overall in a downtrend. I'm going to pull this one up on a relative basis so you can see the relative chart, because I know this one was underperforming. Yeah, it's still just kind of, relative to its peers, it was underperforming, started to outperform, and now it's just kind of going along for the ride, which unfortunately has been mostly to the downside with the group. So there's not a whole lot here that I like with Goldman Sachs. The group is starting to pick up relative to the S&P. So let me just say this about the stock. If we get above the 230 level and we can hold it, so I'm going to put that line in right there. If we can break out above that to the upside, volume's been pretty good here on the last couple of moves. So maybe there's some accumulation taking place. But if we can get that move, and then we can get relative breakouts versus the peers right here, and then versus the S&P 500 right there, I think if all of that occurs, I would start to become a much more bullish Goldman Sachs. Until that occurs, I would be careful with the stock.
Okay. And the final one is going to be BEAT, B-E-A-T, medical equipment, biotelemetry.
Yeah, they just came out with a really nice report a couple of days ago. I don't remember the numbers, but you can see the reaction. I think what we have now is a serious uptrend followed by heavy volume on the right side of a cup that you can see right here. And now we're at a major resistance level. So I wouldn't be surprised to see the stock pull back here, but you can see on a relative basis, it's broken out versus its peers. It's broken out versus the S&P. The group is still performing relatively well versus the S&P 500. So I like everything about this stock except the fact that it is now sitting at price resistance. So I think what I would do is put this on a watch list and let's see if we get a little bit of a pullback. But if we were to get all the way back down, I don't know if we go back down there, but if we were to get back close to this gap support area where we had gapped up to, I don't think we're filling the gap back to 51, but I do think there's a chance we could go to the top of the gap. And notice that if we did do that, we also would be looking at the possibility of a 20-day EMA test at the same time. So that clearly, and that would be a handle, by the way, on this potential cup. So if you're not seeing a cup, I mean, it's not an absolute perfect cup, not a perfectly rounded cup, but I think if you, off of an uptrend, which is required before you can put in a cup, you can kind of see the low here and the move back up. There is what I would be looking at as a cup, and then a pullback to form a handle could be a very nice opportunity to get into the stock. Now, I do believe it's a smaller company, so keep that in mind, probably a little riskier. But this is one that's been accumulated for many, many months, and I think still is in a pretty nice pattern here.
All right. And that does complete the 10 and 10. Here are the stock symbols that we went over. You can find these in the Market Watchers Live chart list. Just go to the blogs tab from stockcharts.com, click on the Market Watchers Live blog, and the link to our chart list is right there at the top. And you'll get all of these charts exactly the same as Tom just annotated them for you to save, annotate, whatever you'd like. All right, time for our final market update. Let us go see what's been going on. And I can tell you what, Tom, interesting 10-minute bar chart right now.
Yes, for sure. This is not looking pretty right now.
Not at all. We're starting to test, and even in the S&P 500, start breaking down below the lows that we saw yesterday. And, you know, not a good look here. The Dow was up this morning, but currently it is down over 1%. The NASDAQ is down almost 2%, actually, at 1.8% lower. And it is getting ready to test the lows from yesterday. And I'm actually seeing what was probably a rising trend here that's now being broken on the NASDAQ. OEX making a straight down move currently. It is down over 1.5%. The mid caps are now lower and in negative territory. Not hurting quite as much, but down 13.22. Russell 2000 down 0.5% currently. And look at the Canadian markets, a big gap on the open, but heading straight down alongside our US markets. Treasury yields are up. They did pull back a little bit over the last hour, currently reading 3.189%. UUP started a little bit lower on the day, but is making a move to the upside. Looks like it might be forming a flag as it tries to cover the gap down that we saw on the open yesterday. Gold is mostly unchanged currently, which I think is a good sign, because since we usually have a reverse divergence or reverse correlation, between UUP and gold, usually they move almost exactly opposite. So the fact that gold isn't falling off a cliff, given the 0.25% rise on the dollar currently, is good news, I would say. TLT bonds headed much lower. Looks like we might be making a turnaround here to take back some of those losses earlier from the day. And USO is down almost 0.75%. As Tom had looked at this earlier, and Mary Ellen, it is now down to 13.36 for USO. And that's all I have for our final market update. Tom, what do you have?
All right. Well, I just want to kind of go over this S&P 500 chart on both the daily and hourly chart. So let's take a look first. Right now, we've got a very ugly bearish engulfing candle right at the 20-day moving average. I find that to be very bearish. I don't like this setup at all. Of course, the candle is not done until the end of the day. Obviously, if we were to rally back today and go back up through the 20-day moving average, I would have a completely different opinion about what's going on here. But if we finish like this or worse, continue to sell off in the afternoon, I think that would be very bearish. And what I wanted to pull up here on the hourly chart, and this is something I'd referred to recently, we broke out of this down channel on the S&P 500, but as we pull back, we have gap support just above 2,700. We went below that. We're trying to hold it now, but remember these defensive areas of the market relative to the S&P and how this uptrend remains in play. And I drew these trend lines. Well, just as the S&P was hitting overhead resistance near 2760, these two of these three relative charts, defensive sector relative charts, were hitting relative support. XLRE is starting to bounce right off of this trend line. Of course, the XLU had already broken down, but here we've got the XLP versus the XLY. Usually I show it the other way. But when the XLP is rising faster than the XLY, that's not a good thing. That means money's rotating towards defense within consumer stocks. And here you can see we are starting to make that turn right at this trend line support. So I think today's going to be pretty big. We had a big announcement with non-farm payrolls, which was great news. We had a nice rally into that report. And I'm just wondering if maybe this is a buy on the rumor, sell on the news kind of event. And Apple's report last night and warning going forward or lowering their guidance is not helping. So this afternoon is going to be interesting for sure.
Absolutely. I know I'm going to be wondering where we close and looking at the sentiment charts and trying to figure out my position for next week's sentiment poll. It's a little bit tough this week, I would have to say. But let's go ahead and get started with that Decision Point sentiment report. All right. So this is the sentiment update for Friday, November 2nd. Let you know what to expect possibly next week based on what we're seeing in the sentiment charts. Remember that sentiment is contrarian, so as an indicator. So when we see bullish activity, bullish sentiment, that actually is bearish for the market, because if everybody gets too bullish, then you generally are going to see a reversal to the downside and vice versa. So let's go ahead and take a peek at what we're going to look at. Oops, sorry. Just always get a little bit heavy on the clicker. All right, sentiment update. We're going to look at the put call ratio, the AAII, American Association of Individual Investors. I'm going to look at the National Association of Active Investment Managers as well. We'll look at their exposure. The RIDEX ratio, I'll explain a little bit more when we get to that chart. And then I had some interesting, I guess, news, you could say, about the VIX that I wanted to share and go over some gold sentiment with you, because that's certainly been an area of question mark lately. All right, so we're going to start with the put call ratio. And I just want to let you know that I do invert scales when necessary so that oversold readings fall on the bottom because it's oversold, and that, of course, overbought readings end up on the top. So in this case, we're looking at the put call ratio, but it's flipped over. So when you get the lower moves on this chart, that is when it is oversold, because you have, extremely bearish sentiment. So that's what we look for, is that oversold reading and rises. And right now, that's exactly what we're seeing. We're getting a rise right off of the oversold lows that we typically have seen, at least over the past 2 years. So I think that that is bullish to start seeing that turning back to the upside, because once we get the rise going, once we get this move going on the put call ratio to the upside, typically that's when you're going to start seeing some market movement to the upside as well. You can also see that the equity put call ratio is bouncing off of its oversold lows as well. Something to look at and keep in mind. All right, so now we're going to look at the AAII poll, and this is a poll. You just go to their website, aaii.org, and you can take the poll. That's very similar to the poll we're running right now live, if you want to go ahead and take that poll about which way the market is. Are you bullish, are you bearish, or are you neutral? And right now, there certainly are more bulls. And looking in the thumbnail especially, I wanted to show you the increase. We have a pretty good increase in bulls and a pretty good decrease in bears. So that is telling me we have some bullish sentiment, right? And when people are getting bullish, that's actually bearish for the market. typically. So I just wanted to point out one other thing is you can see that I wasn't able to do the sentiment report last Friday. I was ill, but I wanted to show you that, we got these very deep bearish readings as well as a very low reading here on the bull bear ratio, and that is considered bullish. And you can see what happened this week is we've gotten a nice rise. So that's why I look at sentiment. That's why I think it's important, but it's clearly more important coming off of some extremes. That's what we want to look at, are extremes. We're not seeing extreme readings right now, I would say, on the bull bear ratio at this point, because it's just only a little bit above 1. So we want to see more activity where you get these very overbought, oversold readings or spikes on the bull bear ratio. All right, next one up is the name exposure index. Now, this is again the National Association of Investment Managers, and they basically tell us on their site how exposed they are to the market, to the upside and to the downside shorting. So currently the exposure index is just above 60, and it's sort of mid-range, but I was looking at it over the past 2 years or so, 2 to almost 3 years, and these readings that we're at right now are actually pretty oversold. They're pretty low right now, and I think that that's interesting to note, mainly because we're down to this area and it is 60, and normally I would consider that a higher reading when we were looking at it back here during that correction we saw in 2015 here on that decline. And typically, that is kind of a not necessarily a real area of oversold exposure, but you can see that when things get very bearish, exposure can get pulled back quite a ways. So that's why I'm looking at this, and I'm really trying to examine it in association with what happened here at the end of 2015 and these readings that happened in this area where we're getting them starting to come in right now. But at this point, we did get a slight increase in exposure, and typically, when you get the increase in exposure, that means that investment managers are feeling a little bit more bullish. And so that actually would be bearish for the market, but again, I'm seeing they're really oversold kind of readings here. It's still very low exposure in comparison to what we have seen typically over the past 2 years. So I wouldn't be reading this as very bearish, even though we have an increase in exposure. I honestly am looking at this as still kind of a low number based on, like I said, the past 2 years. It's still pretty much oversold in the reading itself. So I am going to say that at this point, with all of that explanation, that this chart is mostly neutral. So a lot of explanation to give you a neutral signal here, but I wanted to really just to describe when we get the increase, that typically is a bearish thing. But the fact that we are in oversold territory for the reading, I think that gives you kind of a mixed feeling for this chart. And so that's why I would look at it as neutral. All right, right-X ratio, and one of my absolute favorite sentiment indicators, not just because Decision Point came up with it, but because I think it's truly a really great way to measure sentiment, because this isn't like AAII. This is not a poll where you just go and click, yes, I'm bullish, yes, I'm bearish. This actually is where the money is going. So this is telling you what activity investors are involved in, despite what they say, if they're bullish or bearish. That you can feel one way and say that you feel one way, and then when you actually are investing the dollars, not really follow that. One of the reasons we also look at sentiment is, the market is very emotional. It trades on emotion a lot of times, especially when we're in a situation like we are now with a lot of downside movement and a correction. So it's really hard for those polls, I think, to give you a really serious look. I think that the money exchange is more important. Now, with all of that said, what we do is there's a basket of funds that a company called Ridex used to manage. Guggenheim have taken them over, but it's a kind of a closed universe of funds that we follow. We follow the bear funds, those hedge funds. And then we follow the assets that are in money markets. And then we have reported also by Guggenheim the bull and sector fund assets. So this is telling you, like I said, where the money is and what's happening. And currently, as you can see, we are starting to see, look at the spike though. This was, again, I'm so sorry I missed the sentiment report last week because we had some interesting readings for sure. This was a very high reading on bull assets. I mean, we haven't seen anything even remotely that high for some time. And so when you get that extraordinarily bearish activity, you should expect a bounce. And, after that came down, we did end up starting that move to the upside. I mean, you can see the spike over here in the thumbnail and where it actually came in. It was right about in here. So we had that knowledge, I think, up front that there was certainly really a stretch here on the bear funds. So something to consider. And we're now seeing a rise. We got the pullback on that, but we're starting to rise again. So when you see bear funds increasing and then look at what's going on with the money market funds, those are increasing and we're hitting levels we have not seen for a couple of months here, about 6 months, going back into April for the assets on the money markets. So we are starting to really get into that oversold as far as the market is concerned territory, where people are very bearish with their money right now. And that, of course, means that is bullish for the market. So we haven't hit extremes like we did last week, but we're certainly seeing those increases. And equity funds, what's going on there? Flat. Pretty much flat. We're not seeing really an increase, but we're also not seeing a major decrease. And in fact, we have broken that declining trend that we did have on the bull funds. So, that could be positive. We might start to see a little bit of a shift here out of the bearish sentiment into a more bullish sentiment. See some of this money moving down back into the equities. All right, 2 more charts to go. We're going to look right now. This is the VIX. And what I wanted to point out, because somebody was talking about, when do you know when the market's not that volatile? And, one of the ways that I measure it is, I do use a Bollinger Band around the VIX. And the separation between the Bollinger Bands kind of tells you whether the market is really volatile or not. And you can see we had very wide Bollinger Band. In fact, you can't even see the top of it from back here just mid-October, where the market was, I would say, very volatile. And now we're starting to see a little bit of shrinkage in the VIX Bollinger Band. So I think we're starting to lose a little bit of that volatility, and we are seeing the VIX rising, and it's right there at its average at this point. So I look at what's going on with the VIX as sort of neutral setup here, because the volatility is starting to shrink, and we are starting to see lower readings on the VIX. Of course, after looking at those charts for the market update and the reversal we got today so far to the downside, that could see the Bollinger Bands increase a little bit, but I think it's good news to start seeing those Bollinger Bands shrinking somewhat. Gold I wanted to look at, and mainly because we do gold sentiment. We measure that by looking at the premium and discounts for the closed physical gold trust, Sprott Physical Gold Trust. And depending on what it's being bought at, it's either at a discount or it's at a premium. People are, paying that difference. So right now, gold, I have continued to be bullish on. I'm going to stay mostly bullish on gold. you know, I think the dollar is making that comeback. And again, like we saw in the market update, you know, the dollar was up, but gold was mostly unchanged. So I feel like their correlation, and when you look at my gold chart in the DP alert, you'll see it. I would say that, you know, we're looking at a pretty good rise on the dollar. And now we're starting to see, you know, the gold not really losing much, even though we're getting that rise on the dollar. And look at what I really wanted to point out was a surprise to me, was a PMO bottom above the signal line. And we are not in overbought territory as far as the PMO for gold. However, you know, we saw some acceleration here back in August to October, and we really ended up moving mostly sideways. So, you know, I'm going to say that I am somewhat bullish. I'll feel a lot better if we can get above the low that we saw back in 2017. And that pretty much concludes the sentiment update. Let me just give you pretty much a conclusion, let you see what everything was reading. Again, I will put these in the Market Watchers Live blog so you can actually look at that. I don't want to read it to you because I'm going to go and get to my conclusion chart. And we'll really take a peek at what everything is telling us as far as sentiment. And there you go. Gold discounts backing off, but we're still seeing them higher than average. And the PMO, like I said, turned up above the signal line, and that is bullish. All right, so to conclude here, the AAII poll is bullish for the market. The bearish RIDEX ratio cash flow is somewhat bullish for the market as well. Name exposure, we got a good increase, but the readings are still rather low. Exposure is still rather low, so I'm reading that as neutral to bullish. VIX, I say, is neutral. Gold sentiment, you know, like I said, we've got bullish for gold. So when you kind of add it all up, you know, we're in that neutral to bullish territory as far as sentiment is concerned for the market, because we are seeing a lot of bearish sentiment. And of course, bearish sentiment is bullish for the market. So right now, I'd say sentiment is looking pretty good for next week. We'll have to see if it plays out. And like I said, looking at the reversal we're getting today, midday on the market, I'm a little concerned. So we'll have to see. All right, that concludes it. Hey, how about we pull up that poll?
Yeah, what do you think for next week?
You know, I am based, honestly, I was going to go in higher. However, looking at what's going on in the market, and I do want to look at which sectors are coming in, I don't actually have to give my position, the official position, until after the market close, thankfully. And I check out what everybody has said after the market closes as well in this poll. But I'm actually going to go in neutral. I think we're going to see some upside, but I think there's going to be some downside as well. I like the sentiment look, but I don't like price action. And sentiment I look at as more of a confirmation tool.
Okay. Well, I'm agreeing with the poll. 42% of my brain says it's going to go lower, and 46% of my brain says it's going to go higher.
That sounds about right, huh? Mostly unchanged for you?
Yeah, I'm just watching. I'm literally just every 30 seconds clicking, just trying to get an update on the S&P. And we're sitting right now at 2712. So we did bounce off of that earlier low, but we're still down 28 points today with a bearish engulfing candle in play. And we've moved now back down below. In fact, I'll go ahead and
go ahead and look at it. We've got a few seconds here.
Yeah, I'm going to just pull this chart up. I mean, here you can see we're back down below this green line, which is the 20-hour EMA. And that was the problem, you know, on the downtrend, is we got below the 20 and then we struggled. Once we got above, I wanted to see if we could hold it. I think if we close today below 2,700, we're going to lose some key support in terms of gap support, and then also the moving average. So I think we got to be really careful here. I say we go lower next week.
All right. So I've got neutral, you've got lower. We'll see. And the audience right now has higher. So we'll see how it ends.
We'll see who wins, who comes out on top. But we do have a interesting schedule coming up, as you can see there on the screen. I want to thank everybody for being with us today. Special thanks to Mary Ellen for sharing her thoughts on what's hot, what's not earlier in the show. Please remember to complete the survey as you exit. We do love to get your feedback there. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and we'll see you back here on Monday. Happy trading.